friends, I'm excited to discuss today the dividend strategy. I want to discuss my strategy and 3 lessons that I have learned over the years. Many of these lessons the hard way. If you are looking to live off of dividends, to have dividend checks roll in passively so that you can pay your bills and not work a job anymore, this video is for you today. I'm hoping to share lessons that I learned over the years with investors out there so investors around can learn from my experience. I want to start with the first one. As you can see on the screen in front of you right now, the first lesson learned is really understanding that the time to retire is as soon as possible. Work, it can be a scam in my opinion. And so, disclaimer, I know many watching right now love their jobs. This is great. Congratulations. I do not want to take away from that. However, many of us do not. We're not against the idea of working, but it's going to be something different than the traditional office job. It's going to be something more entrepreneurial. It's going to be something that doesn't involve following a specific clock. It's going to be something that's a lot different than taking orders day in and day out from a boss or a series of bosses. And so, as you can see on the screen in front of you right now, the realization that I had, and honestly, I highlight this. I'm not trying to scare anyone. I'm a dividend investor in my 40s, but it gets worse. I'm not trying to scare you, but it gets worse. I'm trying to warn the younger generations right now that time, it really is of the essence. A thought. What if you never had a good boss? You know, you may be younger right now and you may be thinking, hey, I'm working a job. My boss isn't that good, but don't worry. I'm going to have different roles over the years. I'm going to have different bosses. But I'm just trying to throw this out there right now. What if you never had a good boss? Thankfully, a lot of people do, but unfortunately, a lot of people end up in this situation where work, it can be a scam, and there can be bosses over the years, boss after boss after boss, where it's just not a good experience. And so I'm trying to warn the younger generations right now because things change as you get older into your 40s. As you can see on the screen in front of you right now, when you're younger, you're young. You have a lot of energy. When you're young, you have less responsibility, so there's not so much to worry about at night. When you're young, the clock doesn't move so fast. And when you're young, you can kind of put up with it all. Hey, it'll get better, or I can put up with it. It can kind of push it aside. But look, when you're old or older, you may have less energy. I've noticed this myself. I need a little more sleep, little less energy, even though I work out all the time. When you're old, you have a lot more responsibility and a lot more bills. When you're old, and I highlight this because you won't necessarily realize this until you're older, but the clock, it moves fast. You want to do so much in any given day, but the day just flies by. Things go quicker than they used to be in the younger years. I really wish when I was younger that someone had told me all of this because honestly, for me at least, I made a lot of mistakes when I was younger. I wasted a lot of money. I bought expensive things. I lived a luxurious lifestyle, if you will. I wouldn't change anything because I've had a great life and I shouldn't complain. I'm blessed. I'm grateful. That being said, I didn't really have a mentor all these years, all these decades saying, Ian, you ought to think about it this way. You ought to think about it that way. There is no one right way to navigate all of this, to navigate the dividend strategy. But I'm just trying to provide perspective to all of you watching today because I think a lot of people out there in the community, they can do better than I did. And so anyway, as you can see on the screen in front of you right now, the next point is just when you're old, honestly, you can't put up with it anymore. You kind of reach a breaking point. Maybe you could put up with it when you're younger, but you just don't want to put up with it. And so there's some solutions. The first few solutions here are for younger people. The latter solutions are for older people. So there's solutions here for all. But please don't waste any money or time when you're young. Be frugal, be scrappy, invest wisely. Time is such a valuable resource. I've shared so many spreadsheets on this channel that just shows the value of the dividend snowball, the compound interest over time. Time is a really valuable resource. Do not waste it. Do not spend money on stuff you don't need. Educate yourself and your kids at a young age. Time is of the essence. Keep fighting. You can do it. I've been going at this for a long time. The community here is to support each other. But here, those were kind of some of the things for the younger folks. Here's some things to consider for the older people watching. Consider partial fire. And so financial independence, retire early. If you reach a breaking point, if you kind of get to that brick wall, so to speak, there are options. One option is just to take a lower paid job that may be more exciting or more stress-free. Another option is just to work more limited hours. You can still earn earned income and use it to pay bills, but as the dividend portfolio grows, it can pay for a lot. And so there's that balance, there's that partial fire. I think that's a great solution. Another solution, as you can see on the screen in front of you right now, don't write off the idea of having these kind of trade-offs. Consider them. Geo Arbitrage. Here we go. Hey, Ian. Have fun. Have fun, Ian, moving to Idaho. You're going to have a lot of fun out there. Where is that again? Oh, it's in Idaho. Okay. Hey, I'm having the time of my life in Idaho. I got this Discovery Series mug today from Starbucks. I hadn't seen this one before. I had the Been There series from Idaho. Now they have the Discovery Series. Look, moving to Idaho is one of the best decisions my family has ever made. We have ever made. It is a great life here in so many ways. I owe all of you an entire video series on what this Geo Arbitrage looked like for my family. But at a high level, it's been great. And it's been great from a lifestyle standpoint for our family, for the kids, for our safety, just for our happiness, but also obviously from a financial perspective as well. And so don't listen to those naysayers out there who may critique you moving from a certain location to another. Just consider your own happiness. But as you can see on the screen, let's keep going. And so some other thoughts. Downsize. Again, don't worry what others think. Oh, you're going to live in that smaller place? Can you really do that? Who cares what they say? They're unhappy. That's why they're critiquing you. And so sell. Here's a good one. I like this one. I believe most dividend stock portfolios can do so much more. Mine included. I know it. And so consider selling lower yielding stocks for higher yielding stocks. Here's a perfect example. I probably have some portfolio cleanup to do. I share my portfolio percentage allocation to each position over on Corner Patreon. I'll link to that in the pinned comment below. I'm so thankful for my patrons. I share some cool stuff over there. And on Corner Patreon, we also have Zoom meetups from time to time. But anyway, I have too many positions. Some of these are legacy positions. I hold them. Honestly, something like Campbell's Soup, ticker CPB, it's really for emotional reasons. I've had it so long, I'm just kind of attached to it. But I'm thinking now, trade-offs. Ian, sometimes you have to do hard things. Should I just sell it? As you can see on the screen, if I sell Campbell's Soup, it's yielding 3.3% with no dividend growth. I could just reallocate it, maybe into something like Chevron. Chevron's gone up a lot. Thankfully, I've been buying it the last few weeks. Before it's gone up, I want to buy more. Pretty soon here, I'm probably not going to buy too much more, but it's still yielding 4%. So instantly, I can get a higher yield than Campbell's. But here's the real differentiator. Chevron has a 5-year dividend compound annual growth rate on average of 6.5% per year. So my dividend is growing. This is what I like to call think like a portfolio manager. The portfolio has various positions. Over long periods of time, some of those positions, unfortunately, may need to be optimized. Some may need to be sold. Others may need to be purchased. Campbell's Soup is one that's really bothering me. Another reason it's bothering me, honestly, is I have too much exposure to CPG food and to salty snack foods. And one of the challenges now with our changing world, with the changing government, with RFK Jr. heading up the health division, could things change that put some of these stocks under pressure? Could margins get squeezed? I could probably benefit from having a more balanced portfolio, and so that gets me thinking about it as well. The last thing, though, I want to share in all of this about thinking creatively. If you are older, time is kind of to work too many more years, it's running out, you're getting tired of it, you can't do it, you can't put up with it too much longer. Another option is just to start thinking about retirement accounts. And in particular, if you have been fortunate enough to fund your retirement accounts, why not use money from those just to pay bills? Just spend it. In parallel, on the side, the dividend portfolio can keep growing. Maybe it could keep reinvesting even while you're using the money from the retirement accounts on the other side. The snowball can keep growing. And eventually that hybrid strategy, it can actually help kind of as a stopgap measure. Another one, for example, is if you're not at an age where you can even pull from the retirement accounts and you don't want the penalty from those, why not put a bunch of cash aside? You can use cash, even if you're a dividend investor like myself and you're kind of against selling stocks, you want to live off of dividends, there's hybrid strategies. Why not use cash, some of that saved up money, and just spend it? Just spend it to pay the bills while the dividend portfolio keeps growing. And eventually, if you can delay kind of tapping into the dividend portfolio or minimally tap into it while you're kind of spending through the saved up cash, you're spending through the saved up retirement accounts, eventually the snowball, it may get big enough where it can pay for everything. Even if you feel like, hey, I'm getting older, I wish I started younger. This is one of those strategies. Obviously, the investor, everyone's different, would have to model it out. We'd all have to model out this scenario, but food for thought. I personally have retirement accounts. I'm glad I do because I look at them as a stopgap measure. It's kind of like, hey, when I'm really at that point where I've got to scale down on hours worked and just enjoy life more, I've got those options. I've got those options even if I don't want to kind of tap into the dividends too much, or if the dividends can't even fuel it all, can't pay for it all. And so I love having those options. Okay, before we keep going, I have two more points, two more things I want to discuss in the video today. Before I do, please click the like button if you enjoy the video so far. I'm just trying to do real talk today, trying to share some perspectives, some thoughts that are going through my mind as a dividend investor. But here's the next one. As you can see on the screen in front of you right now, this one kind of ties in a little bit to my Campbell soup example, but really, this is so important. I want people in the community, dividend investors, to realize you cannot predict the future. You must diversify. The stock market, it's going to surprise you. It won't go as planned. Even things that seem low risk, they may have way more risk than you ever thought. You don't assume you know what's low risk and what's not. Diversification, in my opinion, it's the only answer. And ETFs, like SCHD is one that I own, can play a big role in instant diversification. But I want to share with you, because I've been through some setbacks in my dividend journey, and I'm hoping that the community can learn from these by sharing these setbacks, these lessons learned, as part of my dividend strategy. So as you can see on the screen in front of you right now, I want to share just an example of Hawaiian Electric. This is a regulated electric utility. Previously, it paid a dividend since the 1800s. It was one of my best performing utility stocks, and I was way up. Huge capital appreciation. Unfortunately, tragically, the Lahaina wildfire happened. And Hawaiian Electric appears to be settling this for $2 billion. And the stock is now way lower than my purchase price. I'm underwater. There's no dividend now. Will the stock ever recover? First and foremost, my heart goes out to anyone who was affected in Maui, Hawaii from the Lahaina wildfires. Obviously, I'm talking about investing here, so I'm talking about finances, but that should never really, take place of the tragic loss, the tragic loss that happened in Lahaina. Second, as an investor looking at the facts, I am not convinced, honestly, that Hawaiian Electric is to blame for what happened, based on the research I've done. Now, they appear to be settling for $2 billion, but my thoughts, based on the literature I was provided by the company as an investor, is they probably are not at fault for the wildfire. And the fact that they're settling, it's, I think, a perfect example here of this whole category of strategy, of diversification. It's important to diversify because not only could I never have seen something like this coming, but two, I believe Hawaiian Electric in some ways is settling, but should they really have to? I guess that's the best way of putting it. Should they really have to? Because I'm not so sure that they're actually culpable for this tragedy. I'm not so sure of that. Based, again, on the research that I have done, I could be wrong. But anyway, I'm in this situation now where what if I had put a lot more money in that stock? What if it were one of the largest positions in my portfolio? That could have set me back even further than it did. Anyway, some thoughts. As you can see on the screen in front of you right now, diversification is so key. I have risk. I shared it in my last video, which I'll actually link to in the pinned comment below. I have a lot of exposure to CPG Food. I'm a little bit worried about that with the change-ups that are happening in the government because some of the stocks I own may be under a little pressure here from the government. I don't know about that. Maybe I'm going to comment on that in a bit. But again, here's what's interesting. My course of action with Hawaiian Electric. I have two options. I can hold the thing and hope they reinstate the dividend at some point. Option two, I can sell and reallocate to something else, most likely SCHD, a well-diversified ETF with a 3+% starting yield and a very fast, I think it's around a 12% dividend growth rate per year on average, although that's the last 5 years. Perhaps it'll slow down, but anything above 7% is great for me. Here's what's going to happen though. Option one, if I hold, there will never be a dividend again at this company. I'm serious. Option two, if I sell the stock, it's going to instantly skyrocket and reinstate the dividend. This is what happens with these things. It's hard being an investor. It's hard. My gut here, what it told me before was, Ian, hold on to this thing. I've held on to it for a while now. I've let the dust settle. I've seen how this has played out. I see that Hawaiian Electric is having to settle. My gut's now telling me, Ian, it's probably time to move on. Just sell this thing, get the capital to work. Part of this goes to the first point that I just shared. I'm in my 40s now. How many more years can I keep going at the pace I'm going? I don't know. How many more years do I even want to do that? I don't know. If I take something in my portfolio that has a good amount of money in it that's yielding nothing, and if I put it into something like SCHD that is yielding something, that is an instant portfolio-wide cleanup. And if the something I put it into is growing the dividend, even better. Think like a portfolio manager. And sometimes it's painful, it's emotional, because I have preconceived notions of what should have been, how it should have gone down, that this stock, where it should be, what it should be yielding. Well, life doesn't work that way. And so I'm in a position where I need to react to what's happened with all of the information that I have. But broad takeaway is diversification. It is very important, especially for us older investors who are getting closer to fire or semi-fire, because we can't afford so many setbacks. I don't really want to live through another setback on the scale of Hawaiian Electric, but hey, I'm rolling with the punches. But let's keep going. I have another takeaway. I have another strategy that I want to share today. Number 3, as you can see on the screen in front of you right now, this one is perhaps a fun one. It kind of comes full circle. I'm just going to share my strategy. I like to buy quality when others are running away. It's kind of step 1. Identify great quality businesses with strong fundamentals. Great. Step 2. Make sure they have strong and growing dividends. Step 3, buy when the world absolutely hates the business. Absolutely hates it. Step 4, try to avoid others telling you that you're wrong. And step 5, diversify in case you're wrong. You can see here this kind of comes full circle. My investing strategy is in some ways a reflection of my personality. I like to do what others are not doing. I like to buy something that other people hate. It makes me feel good to buy stocks that others are not only overlooking, but they actually want the stock to fail. They want it to do bad. It makes me like it more. I'm a contrarian. I'm a contrarian investor. I go against the grain, if you will. I'm living my life not based on how people are telling me I should. Ian, get up at this time, do this, do that. Step 1, step 2, step 3 throughout the day, rinse and repeat it for how many decades. That's not me. I like to find these opportunities, and I just take so much satisfaction in kind of proving the skeptics wrong. And this comes full circle because I just told you in point 1 today that, hey, a lot of people love that routine of having just a normal job and working it all those decades. That's not for everyone. It's not for everyone. Thankfully, dividends exist for all of us. Dividends are for everyone, and they're a helpful tool that all of us can use to optimize our life, to live a better life, to arrange our life in a way that makes us happy. Anyway, I have an example. This is one of the most hated stocks, I think, in all of the world right now, or especially in America. Boy, check it out. I'm buying Pfizer. I could be so wrong on this. I could lose a ton of money, and so this is not investment advice. Thankfully, I diversify, as I just shared in the second point today and in the steps above. I diversify in case I'm wrong. But this reminds me of AbbVie back in 2019. It does in some ways. Anyway, it's down today. It's down today because President-elect Trump picked RFK Jr. to head the Department of Health and Human Services. He's skeptical. He doesn't like Big Pharma. At least it seems that way. Here's the deal. I'm going to share it. I'm going to share it on the screen. I'm over on X. I'm going to link to my X profile in the pinned comment below. Please connect with me there. But as you can see on X, recently RFK Jr. shared this meme about Big Pharma. He is a skeptic of Big Pharma, at least I believe so based on the memes he's sharing. The risk, the hate for this company, I don't think it gets much bigger than it is in our world right now. Check it out on the screen. That's what I do. It's what I do. Anyway, the price is $26. The dividends, let's start with the EPS, is $2.93 forward. It's trading at a PE of 8.88. I like that. It's turning the corner. I did a video on this recently. I'll link to it in the pinned comment below with their oncology division growing 30% year over year. They're turning the corner. The business fundamentals are strong. It's much hated. Dividend yield is 6.46% qualified dividend. It's growing slowly, but at that starting yield, I don't need it to grow too quickly. For me in my mid-40s, that does a lot for me. I'm buying it. I'm not over-allocating to it. As you can see in step 5 above, diversify in case I'm wrong. But I'll keep buying within reason. I have used this model over the years, and it has worked for me. I've used it a lot of times. We talked about Starbucks. We talked about this earlier, but you may not remember. Over the years, Starbucks has had its issues. At one point, they were having major problems in China and the stock tanked. I bought more because I knew fundamentally this is a great company, but the shares fell down, and I think it was into the 50s at that point. I bought. Then I remember during the pandemic, Starbucks couldn't really operate their business at all. Couldn't get my coffee until finally they opened the door and I had to go in, but they had a little table near the door and I had to order without going into the restaurant. I don't know if that happened elsewhere, like in Idaho, but that's what happened when I used to live in the Bay Area. We couldn't even go in. Anyway, the stock tanked. I bought more. I have a portfolio of world-class businesses. At any given time, some of those businesses may be on sale. If there is a lot of fear out there, panic, sometimes almost a hate for something. I don't think anyone hated Starbucks too much. Starbucks is more a fear. Will they open their doors again? Pfizer here, it's literally some people, for whatever reason, they don't like it. They don't like it. I'll just leave it at that. hey, I'm buying. And so, but anyway, over the years, I try to buy any of my given stocks in my portfolio when it goes on sale for some reason or the other, as long as the fundamentals of the business are strong and solid. Anyway, those are my 3 strategies for today that I wanted to share with the world. This has been a week here post-election where I'm taking a higher level look at what I'm doing. I'm taking a higher level look just at my life and what I've been through as an investor. And I want to share that knowledge here on YouTube, just in case it does get anyone out there in the community thinking. Please put in the comments below, though, whether you agree with me, you disagree with me, you have different strategic things that worked in your own dividend strategy. We're all different. Please share. Also, if you enjoyed the video, you like these kind of videos, please don't forget to subscribe. It means the world to me. Before I go today, in terms of a full disclosure, I do on the stocks mentioned today. I am long Starbucks, ticker SBUX. I am also long Pfizer, ticker PFE. I am long Chevron, CVX, AbbVie, ticker ABBV. I'm long Hawaiian Electric, ticker HE, although I don't know how much longer. I am long Campbell's Soup, ticker CPB, although I do not know how much longer. I don't know if I already said, but I'm also long the ETF SCHD. Before I go today, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed financial advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Please do consult your licensed financial advisor before making any financial decisions. As always, I just share my journey here on YouTube for fun and entertainment. I love you all. Thank you for watching the video. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.